Today we have Mr. Amit Sathe from Tata Mutual Fund. He is a fund manager and senior research analyst at Tata Mutual Fund, managing more than 5,000 crores across Tata FlexiCap, Tata Banking and Financial Services, and Tata Young Citizen Funds. Thank you, Amit, for joining in today.
Thanks for having me here.
So we'll start with a very prevalent question in today's market. We have seen a tremendous rally over the last 1.5 years, since March last year, and markets are trading at all-time high. So how do you look at the valuations in the market today, and what are the key parameters through which you decide whether the valuations are high or low?
So if I look at the broader index level valuations, so I will divide into three categories. Firstly, at a Nifty level, I think valuations are slightly ahead of its probably averages. The real challenge is into mid cap and small cap index, where valuations are fairly stretched, at least at the index level. So mid cap index will be trading at anywhere between say 30-35 times, and if I take out the BFSI out of that, then valuations look fairly stretched. Small cap, similar story. Only thing is that in small cap you have fairly large universe now to look at. So probably index may not be the right way of looking at it. And when we say valuations are expensive, I think there are 2-3 ways that you can look at valuations. Valuation is always a relative game. Relative compared to its history and relative compared to others. So if I look at say Nifty, if I look at Nifty's 15-year or 20-year average, we are somewhere around 16-17 times. Current Nifty trailing forward multiple is almost 21 times. So clearly compared to the past, we are slightly ahead. Similarly, if I look at some of the other markets, emerging markets, India's valuation is fairly stretched or fairly high compared to some of the markets like China or some of the other developed markets. So that is also one way to look at how valuations are stacking up. And third way is what we look at is that the earnings yield versus bond yield. So you have a bond yield minus earnings yield. And whenever we see the gap widening, I think that is also a point where you have a fairly valuations becoming a little challenging. So these are the 3-4 ways that we look at the valuation, and we think that it's slightly stretched at this point.
Correct. So everyone talks about the valuations, and you rightly said that we should measure the gap between earnings yield and the bond yields. What kind of earnings growth estimates are coming in the market? And particularly both from short-term perspective and long-term perspective. So how are we looking at earnings growth, say from a 1 year or 2 years perspective, and how are we looking at from a 5-year perspective?
So for next 2 years, when we look at the earnings CAGR at a Nifty index level, so we are looking at somewhere around 13-14% kind of a EPS CAGR. So that is for the near term. Longer term, I think normally what we say is that you have a real GDP of say 6.5-7%, then you add 4.5% of nominal GDP. So that calculation, say you get a nominal growth of say around 11-12%, add say 2-3% from a active investing style perspective. So another say 13-14% of EPS growth, and broadly similar kind of returns from a investor's perspective.
Correct. So in earnings growth estimates are still in mid double digit, and ideally market should replicate the earnings growth results. So that's the expectation that investors can have from the market. And when we segregate the market, what are the key sectors that you are currently underweight, and sectors where you are currently overweight?
So there are 2 sectors where we are. So in my FlexiCap fund, I'm significantly overweight. Is your BFSI sector and consumer sector. When we look at sectors when to go overweight or underweight, what we look at 3-4 factors: whether the sector has significantly underperformed, or it looks undervalued, or earnings are depressed. So if any of these 2 criteria are getting fulfilled, we normally tend to go overweight on the sector. When I look at say BFSI kind of a sector, first of all, it has significantly underperformed. Not only that, even a lot of stocks, especially private banks, are in my view are fairly undervalued, and now even under ownership is also quite visible in most of the funds. So it's a fairly classic case where if investor is patient enough, I think he will be rewarded handsomely over next say 2 to 3 years. So that is one. Second sector where we, at least personally, I am very comfortable holding is the consumer sector. Valuations are not cheap, but only thing is that the valuations are fairly depressed. So you look at staple names, or you look at even say consumer discretionary names, volume growths are fairly good. So staples would be growing at 2-3% kind of volume growth. So the discretionary might be in fact showing a degrowth in their same store sales. So clearly you have a support of depressed earnings. So whenever economy recovers, and we are clearly seeing some signs of consumption recovering, I think this sector can give you a double-digit EPS growth, which has been missing for last 2-3 years. That is the second sector where we are fairly overweight. So in fact, in our FlexiCap fund, almost 50-55% of sort of exposure is towards these two sectors. Sectors where we are underweight mostly is capital goods, defense kind of names. Similarly, IT, auto, where we are seeing the valuations are fairly stretched, especially IT mid cap valuations are fairly stretched. So that is where we are underweight.
Correct. And I always say that we can't go underweight on India's consumption story.
Absolutely, long term, definitely. I think consumption and bank financials are the two stories without which India cannot survive.
And as wealth managers, we often get these questions that what should be the time horizon for the investment. We always say that when you're investing in equity, you should have a time horizon of more than 5 years. But when you're picking a stock, what time horizon do you see from that stock pick? And what would be the median duration of any stock being held in the portfolio?
Yeah, so I think when we pick up any stock, so we have some investment thesis or case going for it, and we monitor that company's performance on those assumptions or expectations. Sometimes what we expect doesn't play out in say 2 or 3 quarters time. Sometimes it plays out immediately also. So we normally give say anywhere between 2 to 3 years for any specific stock for our thesis to play out, and our holding period is up to the mark where we become uncomfortable with the valuations. If valuations rise too fast, so even if we might have intended to hold it for say 3-4 years, but it rises too fast too soon, then obviously the holding period can be smaller. We prefer companies which compound more consistently and stable. I think that is a really sweet spot, but nowadays you don't find those sweet spots in the market. But that is what we always endeavor, that try to identify companies which will compound steadily, not necessarily will have a very fast kind of outcomes. So holding period depends on the outcomes of the stock price.
Understood. And we have seen, and there's a talk that there is very high liquidity in the market, and foreign investors have not participated to a great extent in terms of liquidity. So what have been the key drivers of liquidity in Indian markets?
Liquidity is normally attracted towards the past returns. So when the returns are good, normally you see people coming and putting money. So liquidity is always a function of past returns. So till the time past returns are looking good, liquidity will come. So one cannot take an investment decision based on the market is fairly liquid or a lot of SIP flows are coming to the market, because if anything is going to go down, they are not going to tell us in advance that we are not coming tomorrow onwards. Right? So I think liquidity is something so we cannot base our investment decision on a liquidity basis. And the reason FIIs are not coming simply because the valuation part that we discussed initially, that for FII, India as a stock is fairly expensive stock. So from his perspective, he has probably better options available in terms of valuation. So that could be another reason that they are still not coming to India in a big way.
And next question is on the SIP, and we have SIP book increasing every day. We just crossed 21,000 crore of SIP book in Indian markets, and I personally believe that it's one of the most enabling financial tool to create wealth in a common man journey. So should one be worrying about stopping their SIPs during market highs, or should they be just continuing with their SIPs?
I think SIP is something that one should continue. I think because SIP is meant for long-term goal achievement or long-term investment planning. So I don't see a challenge or issue in continuing SIP even at this valuation, because that is the job of SIP, right? Tomorrow market goes through a downward phase, you have a chance to average it out. So I don't see that should be a question here. In the sense that should be a doubts in the minds of investor that whether should I continue doing SIP. I think asset allocation is something investors should always look for. Which asset class has not given returns or has given a lot of returns? So how do you position yourself in those asset classes? I think that becomes extremely important, because at the end of the day, your selection of asset class determines your 80-85% of your total returns, not that the percentage or the not that the actual return given by that asset class. So
correct. And how do you look at the interest rate market? We have seen some indications on the rate cuts. How are you looking at in the next 1 year?
I think that so in India, the rate cut will be a function of what does Fed do. Before RBI does rate cut, it has got other options available to lower the funding costs. So if you look at the say something called cash reserve requirement (CRR), which is still 50 basis point higher compared to the pre-COVID level. So I think that tool is also available with RBI. Before they cut the repo rate, they can reduce CRR so that flow of money in the economy improves, and that itself will bring down the funding cost or the borrowing cost for corporates. So I think in India, rates, what we can clearly see is that rates have peaked out. At least there is case for increasing rates looks unlikely. When it will come down, in what quantum it will come down is always difficult to predict. But I think what we have done is that we have positioned our portfolio that whenever it happens, the stocks that we own should benefit. So that is how we have positioned ourselves.
Understood. Thank you so much, Amit, for so beautifully explaining everything and sharing your views. Just last point on your AMC. If you can highlight some of the points about Tata Mutual Fund and some of the best practices that you deploy at the fund.
Yeah. So I think one of the most important part of any AMC is what is your investment process. I think what we use internally is that something called GARP, growth at reasonable price. It is nothing else but say I will say Lakshman Rekha for which stocks to buy or which stocks to sell. It's a valuation driven as well as fundamental driven kind of a model, and we have been using it for last 6-7 years, and that has also helped us to generate more steady performance. So we may not be rocking the charts at extreme bullishness of the market, but we always be holding our funds performance very well in a tough market. So clearly the reason for consistent performance is that GARP framework, and that also takes away the human element that you will have in fund management side. So I think that is a very, very big important kind of a part of our investment process. Second, obviously Tata name itself forces us, or it's a name where we have to be extra cautious when we construct our portfolio. So that gives us added responsibility. I think that name also carries a lot of weightage or weight on our shoulders. So, and we have a big responsibility to sort of justify that name. So broadly, these are the two things probably I will say from a Tata AMC perspective, which are very important.
Thank you so much. And as you rightly said, that we always look at not just returns but risk-adjusted returns.
Right.
And if the funds are doing well on risk-adjusted basis, then we also add them in our portfolios. So thank you so much, Amit, for such a lovely session today.
Thanks.
And we look forward to doing some more sessions with you and your AMC.
Well,
thank you.
thanks.
Thank you so much.